Let's go ahead and talk about the remeasurement and translation of a foreign subsidiary's trial balance. Remeasurement is used where the functional currency is the US dollar, but the local record-keeping currency is the foreign currency. If the functional currency is the US dollar, then that suggests, in a very loose sense, that transactions should have been recorded in the US dollar. When we convert from the foreign currency to the US dollar, our goal is going to be to attain the dollar amounts that would have been obtained if the various transactions had been converted to US dollars on a day-to-day or transaction-by-transaction basis. Now let's say we have a subsidiary in Europe which bought inventory on, April 3rd, 2014, when the exchange rate was $1.20 per euro. We'll go ahead and convert that inventory to dollars using that exchange rate. When the goods are subsequently sold, we'll convert cost of goods sold at that same $1.20 per euro rate. If our foreign subsidiary bought equipment on March 1st, 2012, when the exchange rate was $1.50, we'll convert the equipment to US dollars using that rate. Since we will have converted the equipment at the $1.50 per euro rate, the depreciation expense will also be converted at that same $1.50 per euro rate. Ideally, every time goods are sold, the sales revenue would be converted at the exchange rate that existed when the sale took place. Clearly, this is going to be a pretty heavy computational and record-keeping burden, so instead, if the sales are earned evenly throughout the year, if the sales are made evenly throughout the year, we might use the average exchange rate over the course of the year as a reasonable approximation of that day-to-day exchange rate. We're going to have the following schedule of exchange rates for our various financial statement elements under remeasurement. Financial assets and liabilities, we're going to use the current, that is, today's exchange rate. If we're doing the remeasurement on December 31st, 2014, we'll use the December 31st, 2014 exchange rate. Now, financial assets include things like cash and receivables. Virtually all liabilities are financial liabilities. Virtually all liabilities are settled in cash. You pay accounts payable, taxes payable, wages payable, notes payable, bonds payable, interest payable. All of those various liabilities are paid in cash. Very few liabilities are non-financial in nature. Non-financial assets, things like inventory, plant assets, things of that nature, are converted at the historical exchange rate from when that asset was first acquired. Now let's say that on January 1st, 2015 we acquire a foreign subsidiary. From our perspective, time begins on January 1st, 2015. So all of the non-financial assets that the subsidiary owns on the date of acquisition will henceforth and forevermore be converted at that January 1st, 2015 exchange rate. Similarly, as mentioned earlier, expenses arising from these non-financial assets are also converted at the historical exchange rate. If a patent is being converted at $1.20 per euro, then the amortization expense is also converted at $1.20 per euro. If the inventory was converted at $1.10 per euro, then we'll convert cost of goods sold at $1.10 per euro as well. We're going to run into a problem where we have different historical exchange rates for different assets. Again, if we acquire a subsidiary on January 1st, 2015, all of their property, plant, and equipment will be converted at the January 1st, 2015 exchange rate. But after we acquire them, they're going to continue to acquire more plant assets over their existence, and so if they acquire some on June 1st, 2015, that asset will forevermore be converted at the June 1st, 2015 exchange rate. If they acquire more on March 17th, 2016, we'll have to use the March exchange rate for converting that asset forevermore and the related accumulated depreciation and depreciation expense. So we can run into a problem where we have rather elaborate schedules of different categories or groups or pieces of non-financial assets, all of which need to be converted at different historical exchange rates. Regular revenues and expenses, which are earned or incurred evenly throughout the year, we're going to use the average rate. And again, the rationale there is, although we would like to convert these at the rate that existed when that transaction took place, if those revenues or expenses are earned and incurred evenly throughout the year, using the average yearly rate is a reasonable approximation of what the day-to-day rate would have been. If we have one-time revenues, expenses, or gains or losses, for example, if we sell a major asset on March 1st, ideally we would use the March 1st exchange rate to convert the gain or loss on that sale. Again, generally, we're going to, in the interest of expediency, we'll just use the average exchange rate during the year as a reasonable approximation. Our paid-in capital accounts, common stock, preferred stock, additional paid-in capital, are going to be converted at the historical rate from the date of acquisition. And so again, if we acquire a subsidiary on January 1st, 2014 at $1.40 per euro, the $1.40 per euro rate will be used henceforth to convert common stock, preferred stock, additional paid-in capital, and so on. Retained earnings can be a little confusing at first blush. In the year of acquisition, we're going to convert it at the historical acquisition date rate just in the first year. In subsequent years, we're going to carry forward the dollar value of any retained earnings from one year to the beginning retained earnings in the following year. Basically, we're going to take the dollar value of beginning retained earnings, add the dollar value of income, subtract the dollar value of the dividends to get the dollar value of ending retained earnings. That dollar value of ending retained earnings becomes the dollar value of beginning retained earnings for the following period. Under translation, what is also otherwise known as the current rate method, all assets and liabilities are converted to dollars at the current or end of year exchange rate. So all of our assets, all of our liabilities, all of our contra assets, contra liabilities, everything's converted at the current exchange rate, a vast simplification over the remeasurement method. Paid in capital, again, that's going to be converted at the historical exchange rate from the date of acquisition. And retained earnings, we'll do that the same way we did for remeasurement as well. And again, revenues and expenses, we would like to convert those at the rate which existed on the date the revenues or expenses were recognized. We'll generally use an average exchange rate over the course of the year as a reasonable approximation. Let's go ahead and do an example of a translation. Now, first off, before I forget, translation is much more common than remeasurement in the case of foreign subsidiaries. Generally speaking, our foreign subsidiaries have as their functional currency the local currency of the area in which they operate. So translation is going to be much more common than remeasurement. Okay, let's go ahead and assume that we bought 80% of our subsidiary on January 1st, 2015, when the exchange rate was $1.40 per euro, and they've got this euro-denominated trial balance at the end of the year. And if you add up the various debit and credit balances here, you'll find that the trial balance balances just as it should. Now let's assume we've got the following exchange rates. Again, the January 1st, 15 exchange rate when we acquired the subsidiary was $1.40. The end of year exchange rate had fallen to $1.10. The average over the course of the year was $1.20. And on 4/1/15, when dividends were declared, the exchange rate was $1.30 per euro. So we plug in the appropriate exchange rate next to the appropriate financial statement elements, and we convert from euros to dollars. Again, those are direct exchange rate, dollars per euro, so multiplying you'll have euros times dollars per euro with a result in dollars. And so now we have our trial balance expressed in dollars. The problem, of course, is that unless we've got a very strange coincidence, our dollar-denominated trial balance is no longer going to balance. It balanced in euros, but since we applied different exchange rates to different elements, the resulting dollar-denominated trial balance will no longer balance. We're going to need a plug figure to make this thing balance, and under translation, it's referred to as a translation gain or loss, as the case may be. Now, in this case, the credits exceeded the debits by $49,000, so to make this thing balance, we need a $49,000 debit, and so that will be a translation loss. And just pausing for a moment to think about the nature of this loss, essentially we bought the subsidiary when the exchange rate was $1.40 per euro, and apparently the value of the euro dropped steadily throughout the year from $1.40 down to $1.10, so the dollar value of our investment has fallen because the value of the euro, which our investment is measured in, has fallen as well. Okay, so let's go ahead and set up the dollar-denominated income statement. We have sales in dollars, less all of our various expenses in dollars, gives us our income in dollars. And we have the following equity method entries. Again, this is an 80% owned subsidiary. And so we'd say, well, you made $90,000. We get 80% of that 90,000. So we'll have our investment and our investment income. The dividends, we receive 80% of the dividends that they paid. And finally, a new one, we're going to record our share of that translation loss that was on Little's trial balance. Again, there was a $49,000 translation loss. Our share of that is 80%. So we show a $39,200 translation loss. When we do our elimination entries, we're going to follow this the way we've done it historically. We're going to go ahead and eliminate the subsidiaries beginning of year equity accounts. And again, these are the dollar denominated amounts. Once we convert the trial balance from euros to dollars, the euro information is completely useless to us. Our whole point in doing this translation was to get everything in dollars so we can do our dollar denominated consolidation process. So we eliminate the subsidiaries beginning of year equity accounts. We also eliminate the subsidiaries beginning of year, we eliminate the subsidiaries accumulated other comprehensive income of $49,000. And since this is a partially owned subsidiary, that net total is going to be allocated 80% to us, 20% to the non-controlling interest. Now note that before making our elimination entries, both we, the parent, and the subsidiary had the translation loss on our balance sheets. The subsidiary had the entire $49,000, while we had our share of $39,200. The consolidated financial statements should show the parent's equity accounts, including the parent's accumulated other comprehensive income. That's why we eliminated the subsidiaries' accumulated other comprehensive income in the S entry above. The remainder of the elimination entries, A for amortization, I for income, D for dividends, etc., are exactly as they were in the case of the non-foreign subsidiary. Again, the problem is we need to get the trial balance from the foreign currency to the US dollar. Once the trial balance is in the US dollar, then we're back to our standard consolidation problem. When we repeat the process the following year, we're going to again translate all of the subsidiaries' trial balance accounts at the appropriate exchange rate except for retained earnings. As indicated earlier, the dollar value of retained earnings is carried forward from the previous year's worksheet. Let's go ahead and make up a statement of retained earnings in both euros and dollars. Now this is simply the middle part of our consolidation worksheet. Again, we start with our beginning retained earnings, 100,000 euros at the $1.40 historical exchange rate. That was $140,000. We add our income. In euros, the income was 75,000. Our revenues and expenses were converted at the average exchange rate of $1.20. So in dollars, our net income was 90,000. Less dividends, 25,000 euros. And again, the dividends were converted at the exchange rate in effect on the date they were paid, so $32,500. And so our ending retained earnings is 150,000 euros, or 197,500. And there's no single rate that converts from that ending euro figure to the ending dollar figure. Obviously, you could divide 197,500 by 150,000 to get whatever that exchange rate is. But the point is, we carry forward the 197.5 as a lump sum. We're no longer converting by multiplying the end of year retained earnings by some specific exchange rate. Okay, here's our trial balance for the second year, and again, I've already filled in the retained earnings figure. Again, it was 150,000 euros. No individual exchange rate, instead we simply carry forward the dollar value of 197.5. And let's assume we have the following exchange rates. We have our historical exchange rate of $1.40 per euro. That was the rate on January 1st, 2015 when we first bought this subsidiary. We have our 2016 average exchange rate. Now let's assume that the euro exchange rate has gone up substantially, up to $1.80 per euro for the average during the year. And the end of year exchange rate is $2 per euro. So again, we're going to go ahead and multiply all of the relevant trial balance accounts by the appropriate exchange rates and get the relevant dollar amounts. You may have noticed that in this trial balance, I've eliminated all the individual assets and all the individual liabilities, and instead simply aggregated them into assets and liabilities. Under translation, since all assets and liabilities are being converted at the end of year exchange rate, there's really no need to keep them separate. In any event, here's our dollar-denominated trial balance. We add up all the debits and all the credits, and we find that there's a translation gain of $155,500. Again, that's the credit figure that's needed to make that dollar-denominated trial balance. Now, one thing to note here is, in the first year, 2015, we had a translation loss. This year we have a fairly substantial translation gain. And the reason for that is the increase in the exchange rate. Again, we bought our subsidiary when the exchange rate was $1.40. Back in 2015, the exchange rate dropped down to about $1.20. And now in 2016, it shot up to $2 per euro. Basically, that means that even if our subsidiary hadn't gained any value in terms of its euro value, simply because euros were more valuable, the dollar value of our subsidiary has risen substantially. So that's why we have this relatively substantial translation gain. And please note, sales minus expenses, we have Little's dollar income is $180,000, $900,000 in sales, less $720,000 in expenses. Our equity method entries are, again, remember this is an 80% owned subsidiary. We have our share of the subsidiary's income. They made $180,000. We own 80% of that, or $144,000. There's no amortization or dividends, but we do have this translation gain again. Now here's where we need to be careful. When we prepared the subsidiary's trial balance and created that translation gain or loss as appropriate, we had to start from scratch. We had to start from zero when putting the translation gain on the subsidiary's trial balance. In our parents' books, we still have the accumulated other comprehensive income balance left over from last year. At the end of 2015, when we did our equity method entries, we recorded a translation loss of $39,200. That was part of accumulated other comprehensive income. So that's sitting on the parent's balance sheet in their owner's equity section. And again, that was 80% of Little's translation loss last year. Now Little has a sizable translation gain, and our accumulated other comprehensive income needs to be 80% of that gain, or $124,400. So we need to make our accumulated other comprehensive income account swing from a $39,200 debit balance to a $124,400 credit balance, a change of $163,600. So we're going to go ahead and record the translation gain of $163,600 with a debit to the investment in Little. Now, as a result of doing this, our accumulated other comprehensive income translation gain equals 80% of the translation gain on Little's dollar-denominated trial balance. Finally, our elimination entries for 2016 would start as follows. Again, we're going to eliminate the subsidiary's equity accounts. So we just pull these straight off the subsidiary's trial balance, the dollar value of common stock, the dollar value of retained earnings, and the dollar value of that accumulated other comprehensive income translation gain. All of these subsidiaries' equity accounts need to be eliminated, and that total, we're going to split that 80-20 between the investment in Little and the non-controlling interest. And by doing this, what we're doing is we're assigning to or allocating to the non-controlling interest their 20% of that translation gain. We, the parent, have already recorded our 80% of that translation gain in our equity method entry previously. Again, once doing this, the balance of our elimination entries proceed just as they would have if this had been a domestic subsidiary. A for amortization, I for income, D for dividends, etc., etc.